Hello and welcome back to goldstocktrades.com. Today we have Mark Smith. Mark is CEO and president of Largo Resources. Largo can be traded as LGO on the TSX Venture. Thanks, Mark, for being here with us today.
Always a pleasure, Jeff. We're glad to be here.
Mark, Largo owns the Marrakesh mine, which has some of the highest grade vanadium yet discovered. Talk to us about some of the recent challenges at the mine. You recently came over as CEO of Largo. What opportunities and challenges do you see at the mine, and how do you see those challenges being overcome in 2015?
Well, Jeb, let me start out by talking about the opportunities, because obviously that's why I'm sitting in this position today, is that I see unbelievable opportunities for this company. As a general rule, I look at opportunities in a very simple way, where you've got a wonderful resource. In this case, we've got an absolute world-class vanadium resource down in Brazil. You couple that with good metallurgy, and the technology for processing vanadium is very well known. So we have a very good metallurgical process. You put all that together with what I consider to be just a fabulous team of people, that's a recipe for success. So I see all the ingredients to put together the right recipe for success here. And now what we have to do is to get focused on a couple of those little things that have continued to bother the company, namely the ramp-up process. And that's kind of an interesting issue as well, Jeb, because you kind of think about what the mine and the plant people have done in just the last 10 months, and they are achieving in excess of 60% of the plant's capacity right now for production. That is actually a very good track record in a very short period of time. But the market, of course, expects things to happen faster than that. And we respect the market and their opinions, and so we are working very hard at increasing the production level and achieving that 100% of phase one capacity. We're sticking with our timeline and saying that we will achieve that by late August or early September. And I've been down to the mine, heading down there again next week. View of the issues at the mine are actually pretty straightforward. We have some engineering issues that need to be addressed, not metallurgical design issues. These are engineering issues, and if we can put into place more robust conveyance systems that take the material from one step of the process to the other, we will solve the majority of the issues that continue to impact the company. And the good news here is that we are addressing those. We're putting redundancy into the design as we move forward. And what people are going to see is just this constant increase in production levels, and they may be small right now, but they're significant to us. In May, as you know, we just issued a press release saying that we hit another production record for the month. We hit 487 tons for the month. I anticipate that we'll do that well, or maybe a little bit better in June, and then again in July. But in August is when a lot of the new engineered features that we've designed and have had built outside of the company start arriving on site, and we get to put those new engineered systems into our plant. And then you're going to see the production level of the plant very quickly get up to that phase one level. We are confident, we're excited for that time to come, but we're using every single day as another day to learn more about our process and become more and more comfortable with it.
So, Mark, maybe you can talk to us a little bit about, you mentioned about August. Could you talk to us more about some of this 2015 production guidance and some of the objectives you have here?
Absolutely. And one of the additional features in terms of opportunity for this company is the potential to be the absolute low-cost producer of vanadium in the world. Our goal is to achieve the phase one levels in late August or early September. That's roughly 9,600 tons per year production rate. And as we achieve that production rate, we will then exit the year with our unit production costs at about $3.21 a pound based on V2O5. Currently, the lowest cost producers in the world are in China, and that's a co-production process, so it's very different than ours. The economics are very different, but even their production costs, their unit production costs, are $3.50 a pound. So, coupling a fantastic resource, great metallurgy, great people, and putting it together to form a low-cost unit production facility, again, it's the absolute recipe for success.
Mark, Largo recently raised capital. Talk to us about the financial situation of the company, as that's critical when you're talking about a production story, that you have enough capital to deploy here.
Perfect introduction to some exciting things that are coming to a conclusion, hopefully as early as today. Largo had put together its financing for the project a couple of years ago. And of course, they had an expectation of what their ramp-up schedule was going to be and what their project schedule was going to be. The loans were part of that process. It's about $200 million in loans for the company, and then they'd raised enough equity to put the project together. As a result of a little slower production ramp-up and a little slower construction process that they went through, what we found was that the payment schedule under the debt facility came up awful quickly compared to what we were prepared for. You couple that with historic low pricing in the vanadium market, and we really needed to sit down with the banks and talk about the payment schedule on that debt. The great news is that the three Brazilian banks and then the government-owned Brazilian bank that are part of the debt syndicate were extremely cooperative, extremely supportive, because they also see the opportunities that are available to us as part of this project. And so we sat down in the last 2 months and put together a new timing schedule for payments. We've extended the majority of the amortization payments out by 1 year, and we've also extended the loan maturity dates out by 3 years. So it really provided the needed cash flow relief for the company as we're ramping up and as the vanadium market is turning around, which it is. We then coupled that with an equity raise as part of our renegotiation of the debt package with the banks. They did want additional equity raised. The number that was a condition precedent was $35 million US. Ultimately, at the end of the day, when we were done with our equity raise, again, the markets came in and they expressed a very strong level of confidence for this company and its abilities, and we were able to raise $75.2 million Canadian. So we put that new debt schedule together, and we put our equity into the treasury, and we now are a company that is on very sound financial ground as we continue to go through the ramp up and as we see the vanadium market starting to turn around and become much more robust. So it's an excellent time for the company, puts us in solid, confidential ground to move forward. And now we are going to be absolutely laser focused on getting that production level up to where it needs to be, because this company can generate a tremendous amount of cash flow given the right market conditions and the right production levels.
Mark, let's talk about market conditions, especially with regards to vanadium. $5 has always been a historical floor, but since the credit crisis in 2008, 2009, we've seen vanadium prices depressed around this $5 level. You've been in the specialty steel sector for over 3 decades. Talk to us a little bit about the cyclicality of the sector and what supply-demand fundamentals may be there for vanadium and for a pure play producer like Largo.
Yeah, it's a great introduction because, of course, we're very focused on this market, and we're trying to put our plans and our strategies together based on our best understanding of the market. And right now, Jeb, it looks as if the total supply in the world is somewhere around 127,000 tons of V2O5 equivalent. and the total demand is somewhere around 136,000 tons of V2O5 equivalent. What we have seen in the last couple of months, 3 or 4 months to be precise, is that we've seen historic lows in the pricing of vanadium. But if you take a look at the 10-year pricing charts for vanadium, what you'll see is that there was only about a 30-day period during the last 10 years when vanadium went below $5 a pound. And that is a very good explanation for that, and that has to do with the cost of production for the primary, the secondary, and the co-product production for vanadium. As a general rule, the highest cost production is secondary production. That's roughly $6 a pound to produce. The primary producers are producing somewhere around $4.50 a pound, and then the Chinese co-product or slag production comes in at about $3.50 a pound. So when the market moves the pricing below $5, you actually see a very quick reaction from the supply side of the market because it's strictly economics. They just, you can't produce vanadium at $6 a pound and sell it for $5 and stay in business long. So supply then exits the market as a result of those economics. The supply-demand situation turns again, so there's a shortage, and then the prices go up. So that's kind of what you've been seeing for some time now. What we do anticipate, however, is that there are some things going on the supply side, both short-term and long-term, that we think are going to have a very positive effect on vanadium prices. There are several issues going on in South Africa right now, where about 35,000 tons of vanadium are produced annually. There is one facility in particular that is a 5,000 ton per year producer that has claimed force majeure to all of its customers. There's another producer, probably in the 10,000 ton per year range, that has just put their company into what in the U.S. we would consider bankruptcy. So there are some very serious issues with 10 to 15,000 tons of supply in South Africa. So we think in the short term we're going to continue to see the market react to those supply issues, and we do anticipate prices continuing to increase. Over the longer term is where I get really excited, Jeff. When I sit there and I think about the base reason why roughly 70% of the material is coming out of China today at $3.50 a pound, it's because they are producing a co-product material by utilizing the iron ore from Chinese iron ore mines. And that ore happens to be a hematite type ore, and that hematite ore is the reason why they can then process the iron, and as they're making the steel, they end up with a slag that has a relatively high concentration of vanadium, and then they pull the vanadium out of that slag. The problem with that industry is that the Chinese iron ore only makes up about 10 to 12% of the world market for iron ore today, and China has the highest cost production for iron ore of anyone in the world. It's about $125 a ton for China to produce that iron ore. Well, iron ore is selling for probably about $60 a ton today, and I think that it's going to be very difficult for many of these Chinese iron ore producers to stay in business for very long when their unit costs are twice as high as what they're able to get in the market. And when you think about 10 to 12% of the iron ore market that is impacted because of cost of production versus price of iron ore, and yet 70% of the global supply of vanadium comes from that iron ore, you can understand how the mathematics of supply and demand in vanadium could be impacted very quickly. And I think we could really see a much better long-term position for vanadium, and particularly at Largo, where we will be a primary producer with the lowest cost production in the world.
Mark Smith, CEO and President of Largo Resources, which can be traded as LGO on the TSX Venture. Thanks for being here and for giving us an introduction into Largo and the vanadium market.
Jeff, it was our absolute pleasure to be here. We look forward to providing you updates as things continue to ramp up, and it's always a pleasure.